Let's talk about withholding tax on interest income or interest paid. Take an example. Jovema Digital Consultants is a resident company registered under laws of Uganda, and let me say is a subsidiary to Jovema Investments, a non-resident company, maybe best, let me say Kenya. And Jovema Digital Consultants gets a loan from Jovema Investments. This loan is a loan to a resident company, but from a non-resident company. And this loan is meant to help Jovema Digital to run its business operations, basically. And there is this interest. Let me say the loan is interest bearing, and there is this interest that is payable on that very loan. So there is withholding tax of 15% that is charged on such interest. Now, this interest, we have to know at what point are we supposed to pay withholding tax. The general rule is we pay interest at the point, we pay tax at the point of paying the interest. For example, we have got a loan, it attracts a certain interest, and this interest is supposed to be paid within this financial, let me say 2021, 2022. And by any way, maybe Jovema Digital can't raise this money at this point and says, let's defer this interest, let's pay you in the future. So this interest that is accrued to be paid in the future attracts a certain tax, withholding tax of 15%. Suppose we don't have any double tax treaty with Kenya. Otherwise, if we had double tax treaty with Kenya, or let me say if it was Netherlands or Mauritius, it would be withholding tax at 10%. But this case, let me say 15%. So we pay this tax at the point of paying interest, when interest is actually paid. Where interest is not yet payable or is not paid and it is accrued for the future, this money or this tax is not paid at that point. So what does this mean? Mind the way you record in your reports or in your books of accounts, and how you record it when you're filing the return, the income tax return. Because if you bring this interest as interest paid, for example, your system, maybe you are using an accounting system, and you use this interest as interest paid, and you record it in the income tax return as interest paid, and you don't pay withholding tax, it means you are not compliant. So if you have not paid the interest, and this interest will be paid in the future, you better create a liability account and you call it interest payable. When you're filing and you say this is interest payable, it will be under your liabilities. It will not be interest paid, because interest paid appears in your profit and loss statement as an expense, which reduces the profit for that particular period that would have been subjected to corporation tax. So the highlight here is, if it is interest payable, please make it payable if it is deferred for the future. But if it is paid and you actually pay this interest, don't forget to charge the withholding tax of 15% where there is no double tax treaty, or 10% where there is a double tax treaty. Thank you so much.